Every beginner trader learns the same rule. When the 50-day moving average crosses above the 200-day, it's a buy signal, the famous golden cross. The reality is different. The golden cross fires after most of the move is already over, produces whipsaws in sideways markets, and has a strikingly low success rate on its own. It's the most overrated signal in retail trading. Today, why it lags so badly, the Confluence filter that catches the real trend turns earlier, and what professional traders use instead. Here's why the golden cross lags so badly. It compares one slow average to an even slower average. By the time the 50-day average crosses above the 200-day, price has typically moved 20 to 40% off the lows. Most of the easy money is gone. Worse, both averages smooth out noise, so the cross can flip back and forth in sideways markets, producing classic whipsaw losses. The golden cross confirms trends that already exist. It doesn't predict trends. Watch this in a synthetic sideways market. The 50-day and 200-day moving averages oscillate around each other, generating multiple crosses, both golden and death, none of which lead to actual trend moves. A trader following every cross gets whipsawed in both directions, losing the spread on every flip. That's the failure mode the textbook never mentions. In a sideways market, the golden cross is pure noise. Here's the fix. Momentum precedes price, and price precedes moving averages. By the time the moving averages cross, RSI has usually been above 60 for weeks, confirming the trend that the averages are just now noticing. Filter golden cross signals with RSI above 60 and rising, and you eliminate the sideways market whipsaws. Or more aggressively, trade RSI crossing above 60 as the early entry and use the golden cross as a much later confirmation. Now the trade pros actually take. RSI climbs above 60 and starts trending. That's the early signal. Price is above a rising 50-day moving average, structural confirmation. You enter on the RSI trigger, well before the slow moving averages finish doing their math. The golden cross, when it eventually arrives, is just a late confirmation that you were on the right side weeks ago. You captured the meaty middle of the move instead of joining at the end. On a real chart, scroll back to any major trend turn and you'll see the same story. Price reverses, RSI clears 60 within days. The 50-day moving average turns up shortly after, and then weeks or months later, the golden cross finally fires. Trading the cross as entry costs you the entire early portion of the move. Trading momentum and treating the cross as confirmation gets you in with the trend. So the golden cross is a lagging average of an average. It confirms trends that already exist instead of predicting new ones, and it produces costly whipsaws in sideways markets. Use RSI above 60 as the leading indicator and treat the cross as a much later confirmation. You'll enter weeks earlier and dodge most of the false signals. Subscribe for the full method and trade your own plan. Education, not financial advice.